Inflation is back, but the trend in inflation is changing. And the way it's changing, well, it's not such a good sign. Consumer Price Index was released earlier today. On a year over year basis. CPI is declining currently at a 2.4% on the surface. This looks like a good number. It has been declining for several months now. CPI on a month over month basis, this is the monthly change, up 0.2%, which is more or less in line with the past couple months. Not a big deal, also. That's good. But the core CPI on a month over month basis, that's a different story. That has risen up 0.3%. And this is the highest level we've seen, maybe 6 months or so, and the fourth consecutive increase. Now, core CPI is the consumer price index excluding food and energy. Those are more volatile components. We expect those to fluctuate. But taking those out, we have core CPI, which is supposed to be stable. That is the part that's actually rising. That's the cost of apparel and rent and all those other things that we would normally expect not to rise so fast. That's the bad parts. Now, compare here core CPI in blue to the regular CPI in red, and we can see 4 months in a row, the core CPI, excluding food and energy, is rising faster, in part due to weak gasoline prices. Now, where is the inflation the highest and the lowest? There are several categories we've narrowed down to these are the most significant categories in the CPI. The weakest include durable goods. Those are those goods meant to last more than 3 years, like washing machines and cars, down 3%. Transportation, over 1% to the downside. Gasoline, down 15% on a year over year basis. Overall energy down 7%, and new vehicles down over 1%. Notice the commonality. These are all related to transportation in one way or another. And we can also say that a lot of these are somewhat discretionary purchases. We're going to tell you why that's important in just a moment. The strongest levels of inflation we see, unfortunately, are one of the biggest parts of our budget: housing, up 4.1%. Owner's equivalent rent up 5.2%. The rent of a primary residence up 4.8%, and overall shelter prices up 4.8%. So this is not discretionary. We have to pay for housing, and the housing inflation continues to be red hot. Now, let's compare two very big categories. Owner's equivalent rent up 5.2% on a year over year basis. Gasoline down 15%. We have surging rental prices and declining gasoline prices. The combination of the two, it's not the first time this has happened. We're going to show you the last time, actually. What is, by the way, owner's equivalent rent? It's also known as rental equivalent. It's the amount of monthly rent that we would have to charge if we're a homeowner, for example. It's the amount of rent that we'd have to charge to be equivalent to the monthly expenses of owning a property. Let's say, imagine we're a homeowner and we want to rent out our house. How much do I have to charge in order to pay for the mortgage, the taxes, all the expenses? So it's essentially, what is the landlord charging? It's a very big metric within housing. Well, in red, that's the CPI, owner's equivalent rent. In blue, that's the price of gasoline. And what we can see here is that gasoline is dropping at a much faster rate than the owner's equivalent rent. Now, surging rent and declining gasoline. Why is there a divergence? How can we explain this? Well, rental contracts are long-term contracts, 1 or 2 years typically. They don't change very quickly. Also, they can only really significantly change if, maybe the tenant decides to move out and we have a new tenant that moves in, resets the contract. Gasoline, on the other hand, is a short-term indicator. It moves under the pressures of supply and demand very quickly, primarily because of crude oil. Gasoline is also considered partially a discretionary purchase. Certainly, we need a car to get to work, but we may cut back on driving, if gasoline prices are too high or the economy really tends to weaken, or we could even carpool for that matter. So gasoline is much more sensitive and subject to economic conditions, rental prices, don't change very quickly because of the longevity of their contracts. When was the last time we had such a divergence? Well, let's go back to 2008, late '08, early '09. In red, owner's equivalent rent. In blue, CPI. And notice what happened here. We had a massive divergence as gasoline prices in late '08, in part due to economic conditions, the beginning of the financial crisis, they really plummeted. Our rental prices went down, but much more slowly. Is the soft landing coming back, by the way? That has been, the topic of a lot of news articles lately. Well, let's take a look at the Fed funds futures. In blue, we have the probability that the Federal Reserve in the November meeting, the next meeting, will be at 4.5 to 4.75%, which, by the way, would represent a quarter point cut. The red line represents the chance of a half a point cut, where Fed funds would go down to the 425, 450 level. Well, we can see there was a big change right around the end of September and the beginning of November. On September 30th, we had Federal Reserve Chairman speak. We're going to tell you what he said and why that was so important. And then shortly after that, we had that non-farm payroll number, which on the surface looked pretty good. We actually dove into the details. It didn't look that good. If you're curious to hear more about that, and how the seasonal adjustments have been adjusted quite drastically. That's just about 2 videos ago. But in terms of with the Federal Reserve Chairman Jerome Powell, he signaled, this was on September 30th on a Monday, that more interest rate cuts are in the pipeline, but he suggested they would occur at a measured pace, intended to support a still healthy economy. So based on the non-farm payroll, now, of course, the seasonal adjustments, let's pretend that didn't exist. Jerome Powell and the Federal Reserve, they believe the economy is quite strong. Not so much of a reason for them to cut rates. So the speculation before this, the Fed was going to cut rates by half a point, that moved down, that ratcheted down to a quarter point cut. The 10-year bond yields are at 4.10 now, above 4% level. And what we're going to see is that there's an expectation the Federal Reserve is not going to cut rates very quickly, at least not as quickly as we thought about 2 weeks ago. Well, here's the Fed funds futures for November, December, January through March. What you'll notice, 84% chance the Fed will only cut rates by a quarter point in November. There's a 79% chance they'll cut only by another quarter point in December, a quarter in November, a quarter in December. In January, there's a 61% chance of another quarter point cut. And in March, there's a 55% chance of another quarter point cut. So we're now looking at 4 quarters, 1 full percentage point between now and March. Prior to Jerome Powell speaking, prior to the non-farm payrolls, certainly prior to today's hot CPI number, the expectation was the Fed was going to cut rates by 1, maybe 1.25 points by January. That has now been stretched out. Think about that in terms of the stock market. The stock market does not like high interest rates, and the stock market was quite strong for quite a while under the anticipation the Federal Reserve is going to cut rates quickly. That's off the table now. By the way, yesterday we spoke about the jobs numbers, but not the non-farm payrolls. We're talking about the Indeed job postings. And there's quite a divergence between the strong and weak sectors, between the strong and weak states. And we've had a tremendous amount of feedback on this video, and I think that you'll find what we spoke about here to be quite interesting. We hope this has been helpful. We look forward to seeing you back soon.